Okay, thanks very much. Welcome to tonight's Zoom, Chavez. Great to have you here. I'm going to make one quick call to everybody. We're now up to 108 people. Send out those messages, get them along because we're going to have a great session of education tonight. Let's not let anybody miss out. Over to you, Chavez. Thank you very much.
Thank you so much, Joe. Welcome to UK Prime Time. I believe everybody is doing good. Today's session is very, very important. We are going to begin episode 9 of Rift Before You Quit. So, and as we are progressing towards, into a mature educational, or you can say complex, informative sessions of Rift Before You Quit, I am going to slowly, uh, you know, mold or slowly take you all through the future of Rift as well in terms of understanding the infrastructure. Right now, we are dwelling around why we built Rift, what is the significance of Rift, what is the current standing of Rift in the market, why Rift, how these games are played institutionally, how hedge funds have been surviving for years, what is the secret sauce, all these things we are covering. Slowly and gradually, we are going to mature along and move towards a future also in these zones. So these sessions are going to become more and more, I would say, important in terms of education, learning, and especially for our community that is flag bearer of the product. You all should be well equipped with the futuristic aspect of Rift as a product as well. And that is where I think, you know, the product is intending to take you to. So today we are going to start with episode 9 of Rift Before You Quit, and we are going to get into the institutional playbook. How professional capital really operates behind the market. Retail traders try to predict the market, but institutional capital tries to control exposure inside the market. Uh, Once again, welcome to episode 9 of Before You Quit. In previous episodes, we explored execution systems, AI driven participation, psychology traps, capital scaling, structured flows, automated structure. But tonight, we move into the world most traders never truly understand, the institutional playbook. Because professional capital does not behave this way, social media trading culture teaches people to behave. Institutions think differently, position differently, manage risk differently, protect capital differently. And if you don't understand how institutional systems operate, you are participating in markets without understanding the environment controlling them. So this is the core reason why these sessions are important as to your position in the market, your position as a user, as an influencer, as a key operating leader promoting the product. Retail thinks about profits, institutions think about survival. Survivability with consistency, something that we have been discussing from day one of these series. Today is the ninth episode, and in the previous 8 episodes, we discussed about survivability with consistency. Also, repeatability. One of the biggest differences between retail and institutional behavior is this. Retail traders focus on making money, institutions focus on staying alive long enough to compound consistently. Real market data says hedge fund survival statistics. According to industry studies, many hedge funds fail between first 3 to 5 years. Not because they cannot generate returns, but because they cannot survive volatility and drawdowns. This shows something important. Even professional capital prioritizes survival first. Institutional systems understand if capital survives, opportunity always returns. And today we are going to get into this deeply. Let's it will be easy for us to draw a line between retail mindset and institutional mindset. Uh, Retail mindset drives around fast profits, high leverage, emotional entries, trend cash chasing, large risk concentration, um, uh, you know, emotion pertaining to logic, short-term gains, buying high, selling low, all sort of, F's that retail traders they undergo with retail mindset. Um, and If we compare it to institutional mindset, it's risk distribution, exposure control, long-term compounding, capital preservation, structured allocation. And that leads to mindset-driven decision, less volatility because emotion is eliminated. Structures are used, which creates the real agent. Retail reacts and institutions they plan. Short-term thinking leads to short-term results. That is the retail mindset, and that kind of eventually drops a retail trader into aggressive trading. So long-term discipline builds long-lasting wealth, and that's what institutions they focus on, they press on. How hedge funds really position capital. Most retail traders believe hedge funds simply buy large positions and hold. That's completely inaccurate. Professional funds operate through layered exposure, hedged positioning, volatility balancing, portfolio correlation management, liquidity sensitive execution. Let's take an example of hedge fund. Bridgewater Associates builds massive success through following diversification of frameworks, macro balancing, risk part parity systems, non-correlated exposure structures, not emotional prediction, but structure. Institutions rarely depend on one position, they depend on portfolio architecture. And this is very important for all of us to understand. And today, it will open your eyes and you will just have a immediate instant realization as to how perfectly the architecture of Rift auto trading engine is already designed. I'm not talking about after a lot of successive upgrades, but from day of launch, how structured auto trading engine is. So let's look at the hedge fund structure, how portfolio architecture looks like. In a hedge fund portfolio of $10 billion, you see, it's an example. This is a typical average composition of portfolio of a hedge fund. Something in equities, something in strategies with algos, some cash reserves, some volatility hedges, some forex exposure, some level of commodities, then bonds. This is how a hedge fund is typically structured. So, and that is budgeted according to risk. So, similarly, you can relate it with auto trading engine, how it deals in crypto, commodities, stocks, forex, um, and so we will not do a comparative analysis of hedge fund versus auto trading engine, but what I'm trying to establish here is the understanding and the idea and the definition of portfolio architecture that professional funds they use. We did not just replicate, we made it even smarter. And imagine you as a retail user plugging into a hedge fund of $10 billion and are able to compound every single day. That is the edge that we have built with Rift. I think this is one of the biggest establishments in terms of structure that we have accomplished with our product. Then comes smart money behavior. Today, we are going to take another term along with us for the next few more webinars. Smart money. Uh, we have we have been talking about institutional funds, institutional traders, high frequency traders. Today, we are going to take one more term along with us, and this will continue for the next upcoming sessions. Smart money behavior. What is smart money? Uh, anyone uh, would like to, you know, just make a guess what is, or who understands what is smart money?
People with inside information or insights and experience,
Very well.
perhaps.
Uh, Correct. You're right. You are very close. Retail traders, they choose movement. Smart money creates positioning before movement becomes obvious. All the institutions, all the capital that is deployed through institutions is called smart money. So from today onwards, whenever we say smart money, we talk about funds that are allocated by institutions. So let's take real example. Tesla's inclusion into S&P 500. Before Tesla got into S&P 500, institutional accumulation increased and positioning expanded quite. If you all remember, I offered few of you personally to buy stocks of a Indian public listed company now. When they were going public, we bought a lot of shares before they went public. It's a food delivery application in India. So that's where the smart money flows. That was a smart money channel through which we invested in that stock. So retail interest surged later after the price movement, and that's when the smart money was already positioned in the whole portfolio, and then retail started to get in, and then investors, they already, you know, they get benefited like this. So we will study the whole curve today. And the pattern repeats constantly in markets. Institutions position quietly, retail reacts louder. Let's look at this chart. This is the initial stage at which quiet accumulation is done in any stock, in any asset. I would say asset that is going to break circuits in the market. So in the institutional accumulation, in the quiet accumulation zone, smart money builds positions silently and patiently. And in the breakout phase, institutions, they drive the price above resistance. And the moment breakout phase happens, from that time retail enters and retail euphoria begins. All the FOMO, all the pump, it starts to take the volume climax, and the moment everything reaches to the moon, from here distribution, in the distribution zone, smart money exits. So this is how the market trend shifts into the real retail demand and exit. They enter quietly, and smart money exits very quietly by averaging out the whole retail market. So these this is a study of market cycle from accumulation to distribution. And this is a typical four phases institutional order flow. Um, in these four zones, as I have explained, the market overall functions like this. And to understand and study these phases, it takes, this is what is taught currently in my MBA class where I'm studying finance. So you all can relate and understand how deeply, you know, the smart money kind of dominates the market and wipes out the whole retail like this. So liquidity hunting. Let's understand the liquidity hunting. One of the most misunderstood concepts in market is liquidity hunting. Large capital cannot enter or exit efficiently without liquidity. After this, we will also learn what happens after the distribution zone. We will also go into, you know, reintroduction of smart money into the same accumulation, same cycle. Today, we are going to look at the whole trend. Let's take real example of Forex stop hunts. Major Forex pairs frequently spike beyond the support or resistance, trigger retail stop losses, and reverse afterward. Retail traders, they call this manipulation, but institutions call it liquidity access. The market moves where liquidity becomes available. It's very natural and very technical, simply technical to understand. This is the liquidity sweep model in which how institutions hunt liquidity. Let's say uh, distribution zone has, you know, kind of took out the craze and how smart money re-enters the market. Institution at the time of retail support, the volatility is not very, you know, high or low. It's not very uh, volatile. The retail traders, they place stop losses just below the support, creating a liquidity pool for institutions. This is how, in a very organized way, markets they function. Then, at the time of liquidity sweep, the price is driven sharply below support, triggering stops and filling sell orders. Liquidity is captured. And from here, the moment liquidity sweep happens, liquidity is taken out, institutions enter just post the liquidity sweep. And these institutions, they do the whole revival. In the phase of institutional reversal, smart money reverses price immediately, and after the sweep, entering long and diving price higher. And once it goes up again, then the retail jumps here again because they at this point the retail loud euphoria is again built, and then the smart money tries to exit once again. So it is, you can say this is how, volume surge, liquidity, increased volume on reversal, is explained. This is a typical market scenario as to how institutions enter, exit, re-enter, and exit again. So we took a walkthrough as to how smart money flows in the market, whole industry. This is how smart money flows. Why risk management matters more than prediction. Retail traders often believe accuracy creates profitability. Institutional systems understand risk management creates survivability. Real data. Even top performing quant firms accept losing trades regularly, focus heavily on exposure sizing, and protect downsizing aggressively. The object is not to avoid losses, the object is to avoid catastrophic losses, big losses that can cause a severe drawdown. And if we remember the mathematics of losses to you know, gains required to come at break even. We can, I mean, if you remember, losing a 50% portfolio takes another 100% to make in profit to come at break even. Similarly, at 70% loss, you need to make 233% again to come at break even. That's how the portfolios at retail level they work. This is not institutional scenario. This never happens with institutional capital or smart money. This is not smart money which gets this big drawdown. Never. So how institutions balance portfolios? Professional capital constantly adjusts exposure, correlation, volatility, sensitivity, liquidity, allocation. This is called portfolio balancing. If we take 2022 market collapse, tech stocks declined sharply, interest rates rose aggressively, institutional funds rotated exposure towards energy, cash, defensive sectors, commodities. The reduced portfolio damage happened. Institutions adapt allocation dynamically. Retail traders usually stay emotionally attached to positions. Today, we will deeply study the dynamic portfolio rotation. How, in the bull market, the share of the dominance of allocation of capital in technology versus energy versus commodities versus bonds versus cash liquidity in the market flows. And the moment market gets under influence of inflation or gets an inflation shock, at the same time the market diversification shifts and slowly smart money starts to flow into energy from technology, into commodities more, into bonds more, and cash. And at the time of defensive rotation, when capital preservation comes to question, when there is, inflation comes back to some stable market condition, again the reshuffle happens, and technology slowly gets to, grab back the capital, and the shift happens from energy back to commodities, to bonds, and to cash in the rotational markets. So this is how the dynamic portfolio rotation happens with smart money as well as uh, retail capital. This is the capital allocation of entire market that we can summarize in the time of different market conditions in the bull market, in inflation shock, in defensive rotation. So I believe this is, making, uh, your brains ready to understand the deeper, um, I would say, you'll be able to connect deeper dots now with further information that we are going to go into upcoming episodes. And the information is going to get more and more complex and mathematical in terms of understanding. I'm not going to get into magnitudes, but the explanation is going to become typically technical. So better you all remember all these. So I'll be talking about dynamic portfolio rotation, smart money. I'll be using terms. And when I use these terms, you should be able to recollect these diagrams in your head so that you understand how capital flows in different market conditions at different types of favorable conditions that market prevails. Capital protection systems. Professional systems are obsessed with only one thing: protecting capital during uncertainty. Institutional protection methods are hedging, reduced exposure, volatility balancing, position scaling, liquidity management, reserve allocation. Institutions understand survival creates longevity and longevity creates compounding. Why retail thinks differently? And this is the reason why I'm bringing retail factor along with institutions, just to make sure that you all draw a line and understand the contrast between the retail and the institution, so that you'll be able to relate it with your own perspective and later understand why are we going more complex into these allocations. Because next coming up features in Rift are going to you know make your understanding, or make your, I mean, they require your brains to be opened along the same lines. That's why I'm pushing on the contrast more. Retail behavior is usually driven by urgency, excitement, social media narratives, emotional volatility, short-term dopamine. Let's take real example, meme stock cycles. Retail participation often explodes during viral hype, rapid price movement, emotional narratives. Institutions frequently use this volatility as liquidity opportunities. Retail traders often enter emotionally exactly when institutions begin distributing exposure. Retail emotion versus institutional structure. I think if I ask any one of you, you will be able to explain. By now, if you have attended all the sessions, you'll be able to, I mean, everybody who attended previously all episodes would be able to give me the whole uh, understanding of what sort of emotions are with retail users, traders, and institutions, what they structure their strategies with. Retail emotion revolves around emotions, over leveraged trades, stressed execution, reacting to headlines, whereas the institutional structure stays structured, portfolio allocation is done in a very systematic, hybrid, in a diversified way, risk metrics are taken care, and there is calm execution environment, there is no stress. There is discipline, diversification, data-driven approach, long-term focus. How Rift connects to institutional principles. Now coming back to Rift. Rift was designed around many of these same structural concepts: diversification, distributed exposure. Today we were able to compare portfolio diversification, architecture of portfolio with hedge funds versus Rift. And now we are connecting institutional principles to Rift auto trading engine principles. Diversification, distributed exposure, structured participation, multi-flow allocation, capital balancing, execution consistency. Rift is not built around emotional participation, it is built around execution structure. So let's simplify tonight's biggest lesson. Retail traders often focus on prediction, excitement, fast profits. Institutional systems focus on survival, structure, risk distribution, capital efficiency, long-term compounding. That is the real institutional playbook. I believe you all, if you all listened to the whole explanation in a uh, also in a vague way, then you will be able to understand 50 to 60% up to extent as to how institutional playbook uh, is there in the market, how institutions they play with smart money, how smart money flows in the market. This is what I wanted to establish, along with drawing the line between hedge funds and Rift, institutional concepts with Rift. So the market does not reward emotion long term. It rewards the structure in the long term. All the participants who understand capital behavior are the ones who survive long enough to scale. In the next episode 10, we are going to get into the future of financial infrastructure, how AI automation structured system will redefine market participation. Topics are going to be future of AI finance, autonomous capital systems, on-chain execution infrastructure, machine-assisted allocation, financial automation trends, evolution beyond traditional trading apps, the next decade of market participation. Thank you so much for joining today. I will see you all in episode 10. Joe.
Chavez, thank you very much. Wow, what a wealth of information. You know, at the beginning, I was expressing to people that this is an education that you would pay hundreds, maybe thousands of dollars for from some YouTuber. On reflection, Chavez, I think it's probably fair to say that what you're bringing to us is probably something that people would pay thousands of dollars on a college course or at
Exactly.
university. Much of this
This
information,
is what is taught in universities, I would say.
yeah, without doubt, you can see the quality of the information and the execution. This is a university grade education, but without the $50,000 bill. I think you're missing something there, Chavez. Perhaps you should start charging. We we start taking screenshots of attendees and sending a bill out. So on the with the hedge funds, it's fair to say that with the hedge funds, they work in an extremely structured way
Mhm.
to be able to distribute the assets that they've collected so that they're spreading those assets out to minimize risk.
Risk and preserve the capital.
Yeah, and preserve that capital. And presumably that's because the institutions are using the money of the investors rather than a retail investor who's using
Of course.
money from his own pocket.
Zero retail investors are there in hedge funds, I believe. Zero.
Yeah. Well, what an education, Chavez. Thank you so much. Just fantastic to see and priceless to have it